Welcome to the Market Mosaic, where every week we are looking at the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to try to formulate a view on where things could be headed over the near term. For this week, all eyes are going to be remaining fixated on what's developing in the Middle East. The hostilities between U.S. and Iran right now shows no signs of easing, and that's continuing to spread havoc in numerous energy markets. And so neither side is really showing any signs of backing down, and we're seeing Iran's retaliating against both military and energy infrastructure targets in multiple countries across the Middle East. And at the same time, tanker traffic in the Strait of Hormuz has slowed to a absolute halt. So again, nothing's really going through the Strait of Hormuz right now. The chart on here shows the number of tanker transits by type of ship going through the strait. So, we can look at oil tankers, liquid petroleum, liquefied natural gas tankers, container ships, and so on. And you can see this drop to pretty much near zero. So nothing's really going through the Strait of Hormuz, and that is just absolutely crippling energy exports in a region that is responsible for about 30% of global oil production and 18% of the world's natural gas. But that's not it. The key energy products extend to liquefied natural gas, jet fuel, as well as ingredients to produce farm fertilizer products. And so we're seeing a big spike in all these energy prices. Oil last week had the biggest weekly gain ever with a 35% rally to top $90 a barrel. Domestically, that's starting to drive up gasoline prices. Gas prices jumped by 32 cents a gallon. That's the third largest weekly gain in the last 20 years. And here's where the rally in energy prices can pose a risk to the economy and the capital markets. So obviously, rising oil and gas prices, that can crimp consumer spending. It also adds inflationary pressures, and that prospect for higher inflation is causing uncertainty over the outlook for monetary policy, and if the Fed can keep cutting rates like President Trump wants them to do so. And so as you can imagine, stocks last week tumbled in response to this dual threat facing the economic outlook and valuations because of the prospect of higher interest rates. And we had the S&P 500 dropping 2% last week. The Dow Jones, though, had its worst week since the trade war erupted last April. So some major selling going on last week. But there are signs that the sell-off is going too far. So we're starting to see breadth hitting oversold levels. I'll talk about that more in a second. Now, we're also seeing several measures of fear in the market are triggering signals that are associated with near-term bottoms. So this week, let's look at how the conflict in the Middle East is driving a pretty major breakout in key commodity indexes and why it's not just energy prices that you should be concerned about. And we'll also look at the stock market's reaction to all this, and why breadth measures, along with things tracking volatility, could actually point to a near-term bottom coming this week. So let's jump right into it. The threat that's facing global commodity supplies, this isn't anything new. We're seeing everything from copper to oil surging higher. So base metals like copper, they've already been rallying because of some pretty significant supply deficits from all the AI-driven data center demand. Now we've got the geopolitical side impacting oil and gas prices. So you're getting this coordinated rally across different commodities, and that's sending these broad commodity indexes out to above key levels. So this is a weekly chart of ticker GSG. It's the iShares GSCI Commodity Indexed Trust. And you can see, after this peak in mid-2022, we had a multi-year bullish pattern form. Really can kind of connect these higher lows along the way with a line. And initially you had resistance at this $24 level. So that is a bullish ascending triangle pattern. And given the amount of time that this took to develop, that breakout above 24 was significant. Well, now we've got this big time follow through above the mid-2022 peak, just absolutely surging higher again on the back of that rally in oil prices, especially. And why is this important? Because the last major rally in commodity prices that happened back during this time frame, this is when you had that big inflation wave that saw the consumer price index, CPI, topped out over 9% back here. All right, so we can track movements in key segments of the capital markets to try to get some insights about what it's saying for conditions in the economy. I've frequently warned about the potential for a breakout in commodity prices. We've been tracking a bullish pattern in commodities and what that means for the inflation outlook. Well, the rally in other inflation sensitive sectors like energy producers that is also sending a signal for this prospect of rising inflation. And what this chart on here does is it plots the correlation to inflation across various asset classes over the past decade. And you can see, along with the commodity prices, the natural resources sector, they're positively correlated to rising inflation, to inflation. But there's one more that I think you need to keep an eye on right here, and we had some interesting action this past week, and that is with bonds. This is an aggregate bond index. It's going to include government, securities, and corporates as well. But just one thing you can do is look at what happened in longer dated Treasury yields. So the initial reaction to the breakout of conflict in the Middle East was that the 10-year Treasury yield initially started to pull back. That reflected a flight to safety trade, but that reaction was quickly reversed. The 10-year Treasury yield ended up rising 20 basis points or 0.2% last week to 4%. So yields are rising, bonds are selling off. And look at, given this negative correlation to rising inflation, a sell-off in bonds is another hint of what the market sees on the inflation outlook, and is not good news. All right, so the jump in oil and gas prices, that's been the real focal point for investors following the events in the Middle East, but food prices could be the next to experience a significant jump in the months ahead, and that is because several key fertilizer ingredients also pass through the Strait of Hormuz, and it's around 33% of global fertilizer supply goes through that strait. And so that makes indexes tracking agricultural products the next area to watch for potential breakouts. So the chart on here, it plots several commodity categories. So we've got gold and silver, copper miners. We have the XLE Energy ETF. On down here, we have an agriculture and livestock index. And you can kind of see, it's almost like dominoes falling. You had the initial warning, the initial move coming in gold and silver stocks, followed by copper miners. Now we're getting a move in energy. Can the agricultural commodity segment be next? And again, this because of what is happening with fuel costs going up for farmers, but that, and you also have fertilizer costs going up as well, and then at the same time, if there's fertilizer shortages, that could impact crop yield. So this agricultural commodities is the next domino to watch, so to speak. All right, so stock market indexes are selling off over fears of rising energy prices and the spillover impact that could have to consumer spending and inflation. But there are finally some signs emerging that this sell-off has gone too far in the near term, with market breadth hitting oversold levels. So what the chart on here does is it plots the McClellan oscillator, that's the line in the middle panel here, that is being applied to the S&P 500. So all the McClellan oscillator is doing is tracking a trailing difference between advancing stocks and declining stocks on the S&P 500. And this oscillator hit this minus 66 level. So it's hitting levels that over the past 3 years, you can see when we get down here, that's marked a near-term bottom, at least a near-term bottom in the S&P 500. And whenever the oscillator gets to this level, it's been associated with positive forward returns. So the S&P 500 just has some shorter-term periods of when we get to these levels, what's happened historically, and average that out. Well, over the next 3 months, these past instances, the S&P's average of 6% gain has been higher 75% of the time. So we're starting to get breadth at oversold levels that is associated with positive forward returns in the S&P. So let's look for a bottom in the index this coming week. Another signal is that we're getting that the sell-off has gone too far. So we're seeing breadth hit oversold levels, but there is growing signs of too much fear as well. So CNN's Fear and Greed Index, that's still close to tipping into extreme fear territory. The AEII survey of retail investors has not deteriorated much, but bearish views are still running above average. But the most significant signal, in my opinion, is coming from futures contracts tied to the VIX. So the VIX is the CBOE volatility index. It tracks implied volatility on the S&P 500. And what the chart on here does is it plots the term structure of VIX futures contracts. And what you want to focus on is the shape of this curve. So this is what's called the term structure down here. And all it's doing is plotting where VIX levels are for these futures contracts that are expiring in each one of these months looking out. Normally, this blue line is upward sloping. Now it's downward sloping. It's called backwardation. Or you could also say that the curve is inverted, since the out months are now lower than the current month. And why is this significant? Because usually when this happens is when the VIX index in the near term gets pushed to high levels. When it gets pushed so high that this term structure starts to invert, a lot of times that's a good signal to be on the lookout for a bottom in the S&P 500. This indicates that there's just too much fear and panic out there, which serves as a contrarian indicator. All right, some big events to watch this week are going to be on the inflation side. So we'll get both the consumer price index as well as the personal consumption expenditures price index, which is the one that the Fed pays very close attention to. Now, keep in mind that when these get released for February and for January, this is before any of the events happen in the Middle East. So you're not going to see what's happening with energy prices being reflected in these numbers yet. But the thing I want to watch for is that we've already seen some key categories, like within the CPI itself. You can look at something called super core inflation, which is core services less housing. And we've already seen some growing pressures building in the super core segment over the near term. And so if we continue to see that with what's happening right now in energy markets, that lends yet more evidence that inflation can start to be a bigger problem for the economy, for the Fed, and for the stock market in the months ahead. All right, one trade idea I want to keep a close eye on this week. I've seen a lot of good relative strength coming out of the nuclear sector. And specifically within that, I want to keep an eye on BWX Technologies, ticker BWXT. And so here's the setup. You can see the stock peaked out late October, early November. It started its initial pullback, after hitting around 220, started this pullback to around the 170 level or so. At the beginning of 2026, rallied right back up and tested that prior resistance level a couple times. And now we're seeing a series of smaller pullbacks. So we're getting smaller pullbacks on that test of resistance. It's a good sign. It shows accumulation. It shows after each test of resistance, the buyers are more quick to step in and overwhelm the seller. So we'd really like to see this 190, 195 level hold on this pullback right here, and then see if we can get price turned back up toward that 220 level. And so we'll be looking for a breakout over that level here in the coming week. All right, that is all